The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Welcome to Stock Take. My name's Nick Cummings, and with me today we have Angus Donohoo, and also joining us all the way from Canada, Graham Witcomb. Well, we might delve straight into it, and we're going to be talking about two big themes today, boys. I think probably the two biggest themes in markets since the initial correction during the pandemic, and they are weight loss drugs and, of course, artificial intelligence. Graham, we might start with you. You cover ResMed, and that share price has been on a bit of a wild ride over the last 12 months. There's been concerns that sleep apnea treatment will reduce once the acceptance of these weight loss drugs rolls out. I think you upgraded the stock and it did quite well on the back of those concerns. But more recently, there's been some data that suggests the severity of sleep apnea for people taking these weight loss drugs does reduce substantially. So can you tell us what's going on?
Yeah, so ResMed's been, it has been kind of all over the place over the past year because of these drugs. I'm not sure how many people would have heard of the specifics of them, but there was a clinical trial released last week, which is what kind of swung the share price around quite a bit over the week, just after the weekend. It was called SURMOUNT-OSA. It's by Eli Lilly, and it was looking at one specific weight loss drug and its effect on sleep apnea for, just particularly for obese patients. These drugs are supposed to reduce weight and then through that have an impact on sleep apnea as well. And so this particular trial did actually show that it improves people's sleep apnea quite a bit. 63% was kind of the headline number. But
wow.
Yeah, so that's for a company that makes what's it called? CPAP machines. The idea of having a wonder drug out there that can suddenly cure sleep apnea is quite a force to be reckoned with, I guess. So that's the big impact. But I don't see it as being nearly as bad as what the market does at the moment, I think.
Yeah, and ResMed's always struck me as a high-quality business. I mean, it operates in a rational duopoly with Philips. It's got excellent margins, excellent return on capital. It seems like the penetration for their product is still relatively low, so there's a good or a long growth runway ahead of it.
The other thing about these weight loss drugs that I think is a benefit to ResMed is if it was some sort of silver bullet, then it might be a bit more threatened. But there's plenty of side effects for most of these drugs. If you look at the kind of adherence rates, it's like less than half of people stick to them for more than a year because the side effects are quite severe in a lot of cases. And after 2 years, you're looking at kind of 1 in 4 people be able to maintain it. So although ResMed's product CPAP is also has quite low adherence rates, it's only around 60% of people end up staying on it. It's not competing against something that's a sudden miracle, which everyone is going to be able to stay on. You're kind of looking at one low adherence therapy versus another low adherence therapy. And I think the attractiveness of the weight loss drugs is going to mean lots of people try them. But if we look a couple of years out from now, then I think CPAP is still going to be quite a frontline therapy for treating sleep apnea.
Yeah, and I think the valuation, I had a look this morning, I think it's at 23 times forward earnings, which really surprised me. I mean, that's cheaper or slightly cheaper than Commonwealth Bank. Is it another opportunity here as it was probably a year ago?
I think so. We've just upgraded it again. So I think at the current price, I mean, the share price deserved to have fallen a little bit, but you're getting ResMed today at a lower kind of valuation than it's been in a decade or more. And although that kind of growth outlook has diminished a little bit because of the weight loss drugs will reduce the prevalence of sleep apnea, particularly mild sleep apnea, will probably be cured quite effectively for a lot of people. But you're still kind of, even running through all the numbers, you're still only getting kind of a 10 to 20% reduction in the total pool of potential patients for ResMed, which sounds terrible. But if you were looking at some sort of mature market that shrank by 20%, then you would expect a very big reduction in the stocks that are kind of participating in that market. Say Woolworths or something or other. If demand for groceries went down 20%, it would rightfully fall a lot. But for ResMed, it's still quite an untapped market that most people aren't diagnosed, despite it being a very prevalent disease. And so I think there's even a case for the rates of diagnosis to go up, because people put off getting diagnosed and getting assessed because they don't really want to really want to try CPAP. They know that it's inconvenient. But now there's this other potential therapy, and I suspect that some people will now kind of consider looking at their sleep apnea. And then once they're kind of in the door at the doctor, I think that's almost a sales opportunity, that the doctor's there. They might try them with the weight loss drugs first, but then once they've been assessed and the doctor says, hey, actually, it's, it'll be better for you to cure it anyway, or to treat it anyway, even if you're not a perfect candidate for the weight loss drugs, well, then that conversation starts and they can start addressing it. Or alternatively, they might go on the weight loss drugs. It works temporarily, but they find the side effects are terrible, but they do experience better wakefulness during the day. They have less episodes during sleep, and so kind of feel better overall. It might be that even if they can't sustain the weight loss drugs because of the side effects, they then see the benefits of treating their sleep apnea and so switch to CPAP. So I think that it's more complicated than just drug cures weight issues and then ResMed goes out of business.
Yeah, absolutely. So it could be an opportunity. Gus, I might bring you in. Have you got any thoughts on ResMed?
I mean, it's just extraordinary when you see the kind of the carnage that technological innovation can have across markets. And ResMed's been hit here, but there's been so many other companies and sort of second order effects and third order effects that you wouldn't necessarily kind of anticipate just from the potential of people changing their dietary habits.
I think that's really important.
Yeah, and what these drugs do is they're just stimulating insulin, which is your main kind of hormone that regulates your metabolism, and they're inhibiting glucagon. So both of these are the hormones produced in the pancreas. And what's remarkable here is this the kind of the key breakthrough that Ozempic kind of leveraged off occurred in 1988. And then clinical trials were in 2008. It was approved as an injectable for diabetes in 2018, and it was in this year when it was the CDC. No, not the CDC. The drug approval, the FDA. They expanded the range of things that could be treated for to obesity, and but that's. You think about the timeline of that cycle, and I mean, for me, I think there's even a salient lesson there about how dangerous or how difficult it is to invest in biotech, because the number of steps that the drugs have to go through to kind of get the approval for mass consumption, the number of potential missteps, and so often these things that they're not even, it's a bit like Viagra originally being a heart treatment. Sometimes it's really trying to target something quite different, and then you get this technology come in and it can just create absolute mayhem in markets. One of the ones that we've been looking into a little bit is a lot of the dialysis machine companies sold off. And, similar to with ResMed here, apparently it's 18 years usually from kidney disease showing before someone will actually get onto dialysis, if they get onto it at all. Wow. So in many ways, a drug that, one of the things with Ozempic, and actually I spoke to a friend of mine who's an anaesthetist, and he tried it, and he said that it reduced his weight amazingly because he stopped craving things that he used to crave. Yet as soon as he went off it, he just started putting weight back on again. So the idea that this is going to have this huge implication, huge impact on dialysis, I mean, it might, but suddenly you've got all of this huge opportunities in the market to be trying to kind of anticipate what's going to go up and what's going to go down, but also huge risks where things that used to be very stable and assured suddenly have this, asymmetrical competitive threat coming at them.
Yeah, absolutely. And I think you said something really important there about the second and third order effects. one stock I cover is Diageo, which you wouldn't think is affected by weight loss drugs. It's the world's largest spirits manufacturer. And at first blush, that would seem like a really big stretch that, Diageo's share price should fall because weight loss drugs are suddenly, the new craze. But the deeper you delve into it, the more it makes a little bit of sense. So it's something I think you've covered a little bit, Angus, with dating apps and the power law distribution of some of these products. And it's the same with a lot of food and beverage categories. So the top 10% of drinkers in the US consume about 60% of the volume, which is a massive amount. So you don't have to change the habits of an entire population. You only have to change the habits of 2 or 3% of the population that are your largest consumers, and they're more likely to be obese. And then alcohol sales could fall, quite substantially. You could see 10 to 20% reductions, and that's the same for fast food, chocolate, and a bunch of other categories that, at first glance, you wouldn't think are affected by weight loss drugs. But as you said with your anaesthetist friend, that the cravings for a lot of these foods and beverages do reduce when people are on these drugs, and it could be a real risk to Diageo. I think in this case, it could actually also be a benefit, sort of like Graham was talking about with ResMed. Diageo has been transforming the brand to a more premium luxury brand. And so they've been getting rid of a lot of these value brands. And I think they're the brands that are most at risk from these weight loss drugs. So if someone's reducing their alcohol consumption a lot, they're probably trading up to a Diageo potentially and enjoying a Scotch bottle over 6 months instead of enjoying a lower valued brand over a week or a weekend. They may even move from beer to spirits, which has been a trend that's happening for the last sort of 2 decades. So I don't think it's necessarily a massive threat for Diageo, these weight loss drugs, but it definitely could be.
That's so fascinating.
I kind of feel the same, that with the threat of these weight loss drugs reducing demand, you can't reduce demand for the whole of someone's spending. If they're spending less on, say, alcohol or food because they're not eating as much, then they're spending those savings somewhere else. And probably, like you said, just buying more premium foods or premium drinks and that kind of thing. I'm not sure if that necessarily plays into ResMed's kind of bull case, but I think particularly for the food and beverage stocks, and I don't think they're much of a risk.
Another thing I've been thinking about here with this is just that, that there's, with technology investing, one of the things that's so interesting with technologies is that they can really go so out of category, because you would think that the main competitors to something like Ozempic would be other drugs, or Eli Lilly own it, but instead you're getting competition. It's competing with things that you just would never kind of you would never have anticipated. And I just think that it's such a remarkable example of kind of the power that technology can have.
Yeah, and I think investors are going to really have to consider the impacts of weight loss drugs, not just in food and beverage, but as sort of Graham pointed to, maybe where those dollars are now spent, because there's one study that estimates that 9% of GDP is lost in the US alone due to obesity. That's productivity losses and medical costs.
Wow.
And that's just an astounding figure. That's trillions of dollars if you look at the world economy and sort of multiply it across. So this is going to be, I think weight loss drugs might be a generational drug in the same way that penicillin was, maybe even birth control. And I think investors are going to have to consider it definitely, and how that affects their positioning in their portfolios.
It suggests to me that there's going to be opportunity in aged care, actually, because you're going to get significant expansion to life expectancy. As I would anticipate.
I think the biggest stretch I've seen, I think this was on Twitter, was that there's a company in the US that sells window tint, and that everyone was going to be skinny, and that they would want people to see them, so that there would be reduced demand for glass tinting.
Buy mirrors. Wow.
Yes.
Funny.
Sell ResMed, buy mirrors.
Well, that might be a chance to move on to our second big theme, which is artificial intelligence. And there's one stock, boys, I wanted to talk about, and that was NVIDIA. I've recently revisited a few of the ideas labs we covered last year, or we wrote up last year, and NVIDIA really stuck out as one that I got wrong. I think I'd probably say it's my biggest error since joining II 2 years ago. It's an error of omission, admittedly. Nonetheless, it
doesn't
hurts.
seem like an error to me.
Oh no, I think it was because I think we, or at least I, had a good grasp on this business and how good this business was. It had a founder owner that owned a couple of % of the stock and was well incentivized to do the right thing by the business. It had a 90%, or still does have a 90% market share, maybe even a little bit higher in GPUs. GPUs are sort of the infrastructure and hardware layer that is driving a lot of these artificial intelligence applications. It had Coda, which is a programming software layer that sort of created this moat around the business. And I think 4 million developers now use that program. So it seemed like a very, very good business. But by the time I came to the stock, it was up fivefold. It was already a $1.2 trillion company. I think the forward earnings estimates had it on 50 or 60 times earnings. Trailing earnings was even worse at about 100 times. But I think the biggest mistake I made here is I really underestimated how much spending was going to go into this infrastructure push in artificial intelligence. So the Facebooks and Microsofts of the world, I mean, Microsoft missed the iPhone. They were second to cloud computing. And none of these big tech companies seem to want to miss out here. And that's just led to hundreds of billions of dollars in spending and capital expenditure going into things like GPUs and data centers. And a lot of that's ending up in NVIDIA's pocket. So I had this rosy scenario where I thought in 2030, I sort of worked backwards and to work out what would they need to earn by 2030 to earn a nice return. And it was something like about $70 billion in net income. And next year, they're on track to earn close to $90 billion in net income. So it's.
But do you think that's sustainable for the next 7 years? Or is this just a short-term kind of massive rollout and then competition will kick in and suddenly they won't be earning that in 5 years?
Well, I think that's the hard question, right? I think on the competition side, the programming software layer definitely locks in, keeps the competition at bay to some degree. But you're right, there are Facebook and Amazon and Microsoft, they're trying to reduce their reliance on NVIDIA. They see the problem this could cause, further down the line. But at the moment, they're sort of probably parking that concern and saying, well, we just need to rush and get these GPUs into our data centers to compete. And you're right, the semiconductors are cyclical. And we are in an absolute super cycle at the moment. So it definitely, as this expenditure, comes back to more normal levels, NVIDIA could get hit. But it's still, I'm still awkwardly uncomfortable not having a recommendation out on this. I think the risks are probably finally balanced here. But yeah, I might check what you think, Gus, because I know this is a space that you look at a lot.
Yeah, I mean, I think, you wouldn't want to be too tough on yourself for this. I think one of the things that it's easy to kind of look back with 2020 hindsight, but if you think about NVIDIA's history as a company, it had this huge kind of cyclical movements with cryptocurrency, and the GPUs had been the they were the key thing for crypto mining. So you had a history there of it moving with these technology cycles. But I remember Jens, the CEO, did a keynote speech in, I think it was 2022, where he was sort of outlining that data centers were turning into these giant artificial intelligence factories. And I remember I watched that and I kind of pushed it at the time with the fund I was at. I was saying, like, this sounds like a game changer, but he's a consummate salesman too. So it's extraordinary if you look at to that point you're making about the capital intensity. In 2017, Microsoft, Google, Meta, and Amazon, they spent $113 billion in capital invested. In 2024, that number has blown out to 724 billion. And I think Graham's question is the right one, which is how long can that spending be sustained for? Are they going to keep spending that? And there's an analyst I really like called Richard Windsor, and I think he frames this question really well. And he says the thing to be thinking about here is, at the moment, there's been this push where the more GPUs you're adding into the models, the more powerful they're getting. But he thinks that there's this sort of tapering off, and that actually it's becoming, you're getting the improvements in the AI model's performance is becoming incremental, whereas the cost of going to the next level of GPU is getting greater. And he thinks that gap is expanding, and that kind of is going to be the trigger that's going to cause this, if it is a bubble that will cause it to kind of implode. Once you kind of get that too out of whack, that they're having to spend too much, but the improvements they're getting aren't material to that. But on the flip side of that, the Anthropic CEO, he gave an interview just about 2 days ago. So Anthropic have a model called Claude, which is arguably the best on many of the benchmarks. It is the best. Anthropic, they're the relatively poor man. I think they've only raised $7 billion compared to OpenAI, tens and tens of billions. But they're a major force in this. And he was actually saying that they're still seeing gains being relative to how much compute goes into it. And it's actually really worth thinking about the history here of how this kind of emerged. A few years ago, and I looked at this a little bit at university, but mostly because a friend of mine who's a very good AI researcher, a guy called Alex Davies at DeepMind, he sort of explained a lot of this to me. And you saw there was this real movement in the AI community between the Bayesians, who kind of believed in this, that their approach was to kind of take these statistical models and try and weight them to try and sort of add more information, and that would shape how these AI models were going to perform. And then there were the neural network people, and they just thought that it was all about putting more and more compute into it, put more and more GPUs into it. And much like a human brain is arguably this enormous number of neurons, once you get to a critical number of neurons, you kind of get consciousness emerging. That was sort of the guiding principle behind the neural network people. And that, John von Neumann in the 50s or in the 40s actually wrote the kind of the basis of neural networks. So this was old technology, but the actual old ideas, but the technology was catching up to it. And extraordinarily, the neural network people, that has been the winning thing. The Bayesians have been left in the dust, and that has been the big change in the AI community in just the last few years, I would say. And so, this is the kind of the billion-dollar, multi-trillion-dollar question here. Is it going to be that the more GPUs that you put into these systems, the more money you spend on the CapEx, is that going to give you the AI edge? Or are these models something more simple, and at some point the performance improvements are going to peter out? And that's the real question, I think, here.
Yeah, it's a really interesting point about the big tech CapEx, because I've sort of noticed that. I think you might have said it in a meeting a few weeks ago, Angus, and I think it's something we've got to really think about, because we own a few of these businesses, Amazon, Google, or Alphabet, and also Microsoft in the Intelligent Investor Select Value Fund. And I guess what you're sort of saying here is maybe these businesses, or that we need to think about, maybe these businesses aren't the asset-light businesses that they were 5 and 10 years ago, that where each incremental dollar of revenue really fell to the bottom line at a high clip. Maybe these are much more sort of almost infrastructure-like companies where there's this CapEx, dollars after dollars that need to be sort of reinvested in these businesses, to maintain their competitive advantages.
I think that's exactly right. I think they've really changed the shape of themselves. That they're, that idea for so long was that these software companies, they were just so profitable because you could kind of make something and then just scale it infinitely. These things are requiring huge capital intensity, and it's just a very different. They've really transformed. But the threat to these businesses, if you can create a model that's 90% as good with $5 million versus needing to spend $50 billion to build the absolute cutting, the very, very top model. I think that kind of profile, these companies could be they could really be getting themselves overextended.
Yeah, and I think that's, again, another really important point. And I think that just because, you think that Microsoft's spending $50 billion on CapEx doesn't mean they're right. I think a lot of these companies throughout the whole tech world at the moment are driven by they just don't want to. It's like FOMO. It's like the fear of missing out. We just do not want to miss AI. And at the moment, everyone's spending on GPUs and we've got to do the same and we'll make it work somehow. But it might not play out that way at all. It might be the complete wrong approach. And so I guess that's something we've got to consider as investors in these businesses.
Indeed. And there's also huge implications here where you have China getting kind of cut out of access to this hardware. So another interesting news development just in the last few weeks, the CEO of Huawei Cloud came out and said that they're not going to be able to get below 7 nanometer. So the United States, they've cut Chinese access to the extreme ultraviolet lithography machines, which make the very cutting edge semiconductors, the cutting edge logic semiconductors. And SMIC, which is the main sort of Chinese competitor to TSMC, the main Chinese fabricator, there's been evidence they produced a new, I think it was one of the Huawei Mate phones, and it was using a 7 nanometer chip. But some of the analysts think that the yield on those chips might be on that production line might be as low as 10%. So the yield is how many chips. So they make these big silicon wafers, and then they kind of engrave the chips into the wafers, and the number of chips that you get out of each wafer of silicon is kind of your yield. And so for a really profitable fab, you need that yield to be over 90%. So this is kind of, again, this AI question is driving this kind of, Cold War that's happening this trade war between the United States and China.
I think it started as a trade war, and maybe it still is, but I think it's getting closer and closer to this all-out economic war. I mean, what you're saying there is correct. The United States, but also the Dutch government and the EU have cut China off, or are in the process of cutting China off completely from the most advanced semiconductor chips that are needed to advance artificial intelligence. You can put them in submarines, you can use them in a whole bunch of applications, and it actually worries me a lot. I mean, there is one analogy to sort of World War II where Japan was cut off by the United States, the oil embargo, where they couldn't get oil. And if that pushes China into a corner, I think it unfortunately and sadly raises the stakes of, or raises the potential of a conflict with Taiwan, because this is vital technology that, all economies really, really need. And to think that China's not going to have access to it, it's a bit scary.
Or it might just encourage kind of investment and innovation in China, where at the moment they are kind of dependent on the West for some of these products. But if cutting them off just encourages them to spend like crazy locally to kind of build up their own industry around this, maybe that's not that good in 10 years' time when they can do it self-sustaining without that dependency on Western manufacturers.
There's a writer that I love called Ian Banks, and he has this beautiful line where he says that technology is a face, it's not a ladder. That there's lots of different ways to get to the top, and I think there is this sort of evolutionary pressure that's being created to force China to innovate. But the semiconductors, they are so complex, and that stock that Nick's covered, ASML, there's 6,000 components go into those. Well, they've got 6,000 companies that contribute essential parts to it that are from all over the world, and they just sort of assemble the machines, the lithography machines. But one of the things that I often think about here is there's the competitive pressure by cutting China out of the supply chain. You're actually, I think, in many ways, you're lowering the bar for conflict over Taiwan, because they lose nothing if there is violence over Taiwan, where most of these fabs are located. So there's sort of it's it's a very high risk policy, I think, to cut the largest economy in the world out of access to kind of the essential technology of the age. Maybe.
Yeah, I thought it was quite interesting that they started building those fabs in the US as well, where I'd be very nervous if I was Taiwan and seeing your one kind of massive advantage being shifted to the US, because if the US can do everything without Taiwan, then there's a lot less incentive to be defending them, I think.
An interesting point there, though, Graham, is the fabs that have gone into Arizona mostly, but a lot of the TSMC fabs, and they're also building one in Europe. They're building them in Japan as well. They're not the ultra cutting edge. They're normally doing, I think, 5 nanometer. The 2 nanometer, the most cutting edge ones are still in Taiwan, and it's partly because the cost of actually. I once saw a thing that the fab in Arizona was going to be costing TSMC 50% more. That was the estimation than it was to be running the same plant in Taiwan. But you know,
do you think it's just a cost issue, or do you think that the Taiwan government has I'm not sure, have they said the top of the line has to stay here?
I would imagine it's a combination of the two for sure, but apparently there really is a cost advantage in because another interesting one is Apple actually have just announced that they're going to be building a plant in Taiwan as well. So there are advantages there. I think it's the pool of workers. It's probably low wages relatively. Maybe it's the supply chains. But the expertise is very, very specialized.
Yeah, it's going to be very hard, I think, for China to recreate the whole supply chain here. I think it's going to be a monumental challenge, and it's sort of an industry that's been developed over 50 years. So I guess I don't think we're close to an answer there, guys.
We haven't solved all the world's problems? Jeez.
We haven't solved all the world's problems.
I feel like we got close.
I think we did get close. So on that note, it might be a good place to leave it. Gus, thanks for joining us today.
Oh, thank you so much for hosting.
And Graham, thank you for joining us also.
Thanks, Nick.
For everyone else, thanks for listening.